Marcus made $72,000 last year. He has $340 in savings. Not because he's irresponsible, not because he's lazy, but because no one ever told him he was operating with a broken blueprint. And here's what's terrifying. Most people reading their bank balance right now have the same exact problem. They're not broke because of bad luck. They're broke because they were trained to be. I'm Alex. I study how money, psychology, and behavior determine who builds wealth and who stays stuck forever. And today I'm going to show you 10 mistakes that keep people financially trapped. Not theories, patterns, repeated quietly, invisibly across millions of lives. If you recognize yourself in even 3 of these, pay close attention. Mistake number 1. You spend first and save what's left. Here's how most people handle their paycheck. They get paid, they cover rent, they buy groceries, they handle subscriptions, gas, going out. Then at the end of the month, whatever survives, they call savings. But here's the problem. Nothing survives. There is always something that eats the last of it. A car repair, a birthday dinner, an impulse buy at 11 p.m. on Amazon. Psychologists call this present bias. Your brain assigns more value to money you can spend today than money you can't touch for 10 years. So your brain is literally working against your future self every single month. The fix isn't willpower, it's structure. Pay yourself first, before the bills, before the coffee, before anything. Even $50, even $20. The number matters less than the habit. But here's where it gets dangerous. Mistake number 2. You treat lifestyle inflation as a reward. You got a raise? Congratulations. You also got a newer apartment, a newer car, more expensive dinners. Your income went up by $800 a month. Your expenses went up by $750. You celebrated your way right back to zero. This is lifestyle inflation, and it's one of the most socially accepted traps in modern life because nobody around you is questioning it. They're doing the same thing. Here's the brutal math. A person earning $60,000 who keeps their lifestyle fixed for 3 years and invests the difference will have more invested than someone who earns $90,000 and upgrades everything every time they level up. Income is not the advantage. The advantage is the gap between what you earn and what you spend. And most people close that gap immediately, every single time. Mistake number 3. You have no relationship with your money. Ask the average person what they spent last month on food. They can't tell you. Ask them how much went to subscriptions. They'll guess, probably wrong. Ask them their actual savings rate. Blank stare. And this isn't stupidity, it's avoidance. Research in financial psychology shows that people who feel stressed about money actively avoid checking their accounts because looking at the number makes the stress real. But here's what's wild. The same research shows that once people start tracking their money, even without changing anything, their spending naturally drops. Awareness alone creates change. You can't manage what you refuse to see. Start looking, even when it's uncomfortable, especially when it's uncomfortable. Mistake number 4. You use debt as a lifestyle tool. Credit cards were not designed to make you rich. They were designed by billion-dollar companies with entire departments of behavioral psychologists whose only job is to make spending feel effortless and painless. Tap, done, move on. But the bill always comes, and this is where it gets dark. When you carry a balance on a credit card at 22% interest, which is the average in the US, you're paying for last month's dinner next year with interest. Compound interest is a miracle when it works for you. It is a prison when it works against you. The people who build wealth don't treat credit as income. They treat it as a tool, used intentionally, paid in full every month. The people who stay broke treat every credit limit increase as permission to spend more. Mistake number 5. You're waiting to make more before you start. I'll start investing when I make more.
I'll start saving when the debt is gone. I'll figure this out after the holidays. This sentence has cost more people more wealth than almost any other mistake on this list, because here's what's actually happening. A person who invests $200 a month starting at 25 with average market returns will have more than double the retirement wealth of someone who invests $400 a month starting at 35. Not slightly more than double. The person who waited invested twice as much and still lost. Time in the market is worth more than the amount in the market, and every month you wait is a month you cannot get back. The best day to start was yesterday. The second best day is today. Mistake number 6, you have no emergency fund, so every crisis becomes debt. Life will break something. It always does. The car, the furnace, the roof, the job. And when it does, people without an emergency fund have exactly one option: debt. They charge it, they finance it, they borrow it. And suddenly a $1,200 car repair becomes a $1,600 debt that lives on a credit card for 8 months. And that $400 in interest, it comes from the future. 3 to 6 months of expenses, liquid, in a high-yield savings account. This isn't a wealth-building strategy. It's financial armor. It's the thing that keeps one bad month from becoming one bad year. Most people never build it, so they live permanently vulnerable, one crisis away from going backwards. Mistake number 7, you learn about money from the wrong places. Show a TikTok finance video with flashy thumbnails, then cut to someone making a bad trade. The internet is full of people who got rich selling the idea of getting rich. The guy showing you his Lamborghini in the thumbnail, the trading course promising 300% returns, the passive income blueprint that costs $497 to access. And people buy it because it feels like a shortcut. But here's the psychology at play. Your brain is wired to seek certainty and speed. Long, boring, disciplined investing is hard to sell because it doesn't feel exciting. So the market fills itself with people selling excitement instead of outcomes. Steady ETF growth versus volatile meme stock chart. The boring strategy wins. Index funds, low fees, long time horizons, consistent contributions. It's not exciting. That's why most people reject it. The wealthiest people I've ever studied did the most unremarkable things with their money, consistently, for years. Mistake number 8, you let your environment design your financial habits. Show social media feed, everyone on vacation, wearing expensive things, eating at restaurants. Your financial habits are not primarily products of your discipline, they're products of your environment. If your social circle spends freely, you will spend freely to keep up. If every app on your phone is optimized to extract money from you, you will spend more money. If you walk by a restaurant every day that smells incredible, you'll eat there. Cut to quiet apartment, no phone, simple setup, savings app open. This is why systems beat motivation. Motivation is a feeling. It comes and goes. Systems are structures that create results regardless of how you feel. Auto-invest on payday so you never decide. Delete shopping apps so the friction is built in. Unsubscribe from promotional emails so the temptation never arrives. You do not rise to the level of your goals. You fall to the level of your systems. Build an environment that makes the right financial behaviors the path of least resistance. Mistake number 9, you think investing is gambling. Every time the market drops, the headlines scream, and people panic. They sell, they sit out, they wait for it to feel safe again. But by the time it feels safe, prices have recovered, and they missed it. Show S&P 500 chart from 1990 to 2024, with recessions marked, but the overall trend clearly up. Here's what the long chart shows. Every single crash in history, 2000, 2008, 2020, looks like a blip on a 30-year chart. Every one. The market recovered, and the people who stayed invested recovered with it. The people who pulled out during the fear, they locked in their losses and sat in cash while the recovery happened without them. Investing is not gambling. Gambling has a negative expected return. The market over any 20-year window in history has never finished lower than where it started. That is not a guarantee of the future, but it is the weight of evidence, and ignoring it is costing them their retirement. Mistake number 10. You don't believe wealth is possible for someone like you. This one is the most dangerous, and it's the most invisible, because it doesn't look like a financial mistake. It looks like realism. People like me don't build wealth. This is for people who started with more. I'm too behind to catch up. And here's the brutal truth. If you believe that, you will make every other mistake on this list without even noticing. Because why avoid lifestyle inflation if wealth isn't coming anyway? Why invest if it's hopeless? Why track spending if it doesn't
matter? The research on wealth consistently finds this. The people who build it are rarely the ones with the highest income. They are the ones who believed it was possible, and then acted like it. Identity shapes behavior, and behavior shapes outcomes. If you believe you're a broke person, you will behave like a broke person. Start acting like someone building something, even before you feel like it, even before the numbers are impressive. Especially then. 10 mistakes, all of them common, most of them invisible. You were conditioned by marketing, by your environment, by the financial habits of the people around you to repeat patterns that keep you broke. But conditioning can be broken. Not by motivation, not by one good month, by repeated behavior, small, consistent, boring decisions made quietly over a long period of time. The person who checks their spending every Sunday, who auto-invests before they see the money, who doesn't upgrade their life every time their income grows, who stays the course when the market drops. That person is not smarter than you. They just stopped waiting for permission. The difference between being stuck and being free is not income. It's behavior repeated quietly over time.